Hello everyone. I hope everyone can hear me. Please leave a message on the chat box in case you have a problem with the sound. My name is Andre Algauer. I'm the Client Service Manager here at Trading Central. And firstly, I would like to welcome and thank you all for joining us for this webinar on how to benefit from bullish or bearish trends for beginners. Today's webinar is brought to you by Trading Central and Exness. Just to give you a quick background, Trading Central is a leading investment research provider to financial market professionals and technical analysts. Is our core business. Our award-winning methodology is backed by time-tested indicators, and our chartists and mathematical approaches match requirements of various investment styles, from intraday trading to swing trading and long-term investments. Last but not least, I would like to introduce Clément Hirson. Clément is a senior technical analyst at Trading Central, and he is in charge of indices, equities, ETFs, and FX for US and Latin American institutional buy-side clients. He received his master's on finance from ESG Management School, and he has over 5 years trading experience, including sales trader at Fortuno, junior trader at Sequoia Capital, and technical analyst at BBSP and Cadron Finance. He joined Trading Central in 2011 and started to provide trading and investment research to US and Latin American institutional buy-side clients then. I would like to invite Clément now to start his presentation. I'll make him the presenter now.
Good morning, everybody. My name is Clément Hirson. I'm very glad to be with you this morning to present to you this webinar. We are going to begin with a quick definition of technical analysis. What is technical analysis? Technical analysis is a study of market action through the use of charts for the purpose of forecasting future price trends. This is our goal today. It's to determine, to find the trends, and after to make some correct decision on the market. But what is a trend? The concept of trend is very important. We often heard such familiar sentences as trend is your friend, always trade in the direction of the trend. The trend is the direction of the market, which way the market is moving. A trend has 3 directions: an uptrend, a trailing range, and a downtrend. So there are 3 trend markets. The first one, an uptrend, rather on the left on the screen. An uptrend will be defined as a series of higher peaks and so. A trailing range is a series of horizontal peaks and so. And the last one, a downtrend, is a series of declining peaks and so. Let's see an example on this is the euro dollar starting before 2010. As you can see on the chart on the left, you can see a red arrow. It means that it is a downtrend. As you can see, there is a series of declining peaks and so on. In the middle there is a green arrow, and this is an uptrend. As you can see on the charts, there is a series of higher peaks and so. And the last one, it is also a downtrend with a series of declining peaks and so. Another important definition for technical analysts on technical analysis is the support and resistance level. Support and resistance are very important for stock price, for FX, commodities, or indices. A support describes a price level that the stock, the pair, the contract try to cross below, but ultimately stay above this level. As you can see here, you can see an important support level on the market. Each time the price try to penetrate this level, you can see a bounce, and it's make a very important support level on the market. On the opposite, you can see a resistance level over there. Each time the price, for example, of a pair try to bypass this level, you can see a correction movement on the market. Let's see an example on this is on a US company stock, but it is very interesting to have a look to this one, because as you can see on the chart, you can see a former support level over there. Each time the stocks try to penetrate this level, you can see an important bounce, and it was a lot of buyers on the market. And after, when the stocks broke below this support area set at 12.20, you can see an important bearish movement on the market. And after, maybe 2 years later, in 2011, you can see that the stock tried to bypass this level set at 12.20, and the stock failed to bypass. Why? Because it is now a resistance level. So it's very important to determine, to find the correct support and the correct resistance level to try to enter a longer or short position on the markets. There is another important definition on for technical analysts. It is a definition of a trend line. What is a trend line? A trend line is a visual representation of a support and resistance in any time frame. Trend lines are relatively simple tools because they can be used to show you the direction of a given asset. They can also be used by traders to predict area of support and resistance level. Why? Because you can see over there that each time the price of a pair of a stock, in this is commodities, try to bypass this trend line, each time you can see an important bullish movement. So it can be used to try to buy on the trend line with a stop loss just below the trend line. So the trend line is a support level. This one is a rising trend line. It is a series of higher peak and so. On the other hand, you can see a declining trend line on the right on the screen. There is a successive lower peaks and lows. Each time the indices, for example, try to bypass this declining trend line, you can see a bearish movement on the market. You can use the declining trend line to try to enter a short position and put a stop loss just above the declining trend line. Let's see an example. This is a chart of the Japanese yen, a daily chart on the Japanese yen. As you can see, for example, during from April to October 2012, you can see a declining trend line over there. So each time the pair try to bypass this declining trend line, you can see a bearish movement. But after that, the Japanese yen broke above this declining trend line over there. You can see that the trend is turning up. So it was an important, very important signal, bullish signal on the market. As you can see, after that the Japanese yen broke above this declining trend line, it was an important bullish movement on the Japanese yen. It can be useful to find this kind of trend lines on some pair, for example, on the market, to wait, for example, the upside breakout of a declining trend line to try to enter a long position, or as long as the pair remains below the declining trend line, it could be interesting to take a short position when the pair is going to test the declining trend line with a stop loss just above this declining trend line. You can see, you can find also on the market some other configuration as channels. For example, you can have some bullish or ascending channel, a range, or descending or declining channel. It's the same idea than a bullish declining trend line. It's better to try to trade in the same direction as the market, to follow the trend. So when you can see a bullish channel on the market, it's better to try to enter long position than short position on the market. And the stop loss, for example, on a bullish channel, ascending channel, should be set just below the bullish channel. Why? Because if the market, the pair is going to invalidate or penetrated this bullish channel, the trend is going to change and the bullish movement is not valid anymore. This chart is a weekly chart based on the French indices, the CAC 40. So as you can see on the chart on the left, during 2001 and 2002, you can see an important declining channel on the French indices. It means that the trend is it's bearish, it's strongly bearish. So as long as this channel is still valid, it is better to try to find good opportunity to take a short position on the market than to try to play a bullish movement. At the end of 2003, something like that, you can see that the market broke above this declining channel. It means that the trend is going is not bearish anymore, that the market is going to the upside, and it is an important bullish signal on the market. So you have another bullish channel over there from 2003 till 2007. And at the end of 2007 over there, the market broke below this bullish channel. It means that the bullish trend is over actually, and it is an important bearish signal. So it is a good opportunity to try to enter a short position over there and to put a stop loss just above the previous high on the market. There is also another interesting tool for technical analysts, which is moving averages. Why? Because a moving average is a trend following indicator. A moving average is based on past price. The most common application of moving averages are to identify the trend duration, and to determine support and resistance level. The blue moving averages here on the chart, the blue one, is a 50 period moving averages. As you can see on the chart, the price stay above this rising moving averages from 2012 till April 2013, something like that. So it means that this 50 period moving average provide a good level of support on the market. When the assets broke below and closed below these moving averages at the beginning of April 2013, it means that this moving average provides now a role of resistance level. So it is a good indicator to show you that the trend is turning down actually on the market, and it is better to try to find some good opportunity to take short position on the market than try to find bullish opportunity. As I showed you before on the previous slides, how you can use rising trend or trend lines on the market. As I told you, it's better to try to buy on the pullback, for example here or here, with a stop loss just below the bullish, the rising trend. For example here and here for the stop loss. This is one possibility on the market, and the second possibility is to wait for the downside breakout of the rising trend line to try to enter a short position, because the previous bullish trend is not valid anymore. On the other hand, if you have a look on a declining trend, what is important to try to do with the declining trend line is to try to take a short position just below the declining trend line when the market is going to test the declining trend line with the stop loss above the declining trend line. On the other hand, the other possibility is to wait for the upside breakout of a declining trend line to try to enter a long position on the market, because the bearish trend is not valid anymore. I'm going to show you now some forecast for the next coming days and weeks on the FX market. I updated the following charts this morning before the webinar, so maybe you can see not the last price, but I updated the following charts this morning. The first example is the Australian dollar. As you can see on the charts, there is no pattern on this one, but on the second chart, it is still the Australian dollar. As you can see on the chart, the Australian dollar broke below a rising trend over there. So this was a first important bearish signal on the Australian dollar. The rising trend line is not valid anymore, and the other important element is that the market is trading below the 50 period moving averages. So for the next coming weeks on the Australian dollar, we are still bearish on this pair. Our stop loss will be set at 97.15, which is the previous support level over there. And now it is an important resistance level. It is Fibonacci retracement, also an horizontal level, and a resistance level. So as long as the Australian dollar remains below 97.15, we are bearish on this pair, and the first target is set at 85.70, and the second one at 80.50 over there on the charts. Let's continue with the euro dollar. It is, I think, an important reversal signal actually on the euro dollar since the beginning of 2014. Why? Because as you can see on the euro dollar, the first important element is that the euro dollar broke below a bullish trend line. This bullish trend line began in 2012, and as long as the bullish trend line was valid, we were bullish on the euro dollar. But at the beginning of 2014, the euro dollar broke below this declining trend line, and as you can see a very important bearish movement on the euro dollar. And for us, it is a very strong bearish movement actually on the euro dollar, and we are expecting a further downside in the coming weeks. And the first support on the euro dollar is set at 1.2750. 1.2750, it is on horizontal level. It is a previous bottom, and the downside breakout of this level should trigger bearish acceleration on the market in order to see 1.2040, the previous bottom of 2012. Let's continue with the Canadian dollar. The Canadian dollar, it's very interesting too. Why? Because actually the pair is trading above a bullish trend line in progress over there since 2012. So as long as this bullish trend line remains a support, we are still bullish on the Canadian dollar. Sorry. The second bullish element is that the pair is trading above the 50 period moving averages over than blue on the charts. So as long as the 50 period moving averages provide a support, and as long as the Canadian dollar remains above the bullish trend line in progress since 2012, we are still bullish on the market. Our stop loss is set at 1.06. 1.06 is the previous bottom on the Canadian dollar over there. It is an important support level. So as long as this support, this level remains a support, we are still bullish. And the first target to the upside is set at 1.1250. 1.1250 is an horizontal level too. It is the previous high of 2014. And the upside breakout of 1.1250 should trigger a bullish acceleration in order to see 1.17. So we are bullish on the Canadian dollar for the next coming week. It is better on this pair to wait and to try to enter long positions than to try to take some short position. And the last one is the Japanese yen. The Japanese yen is very interesting. Why? Because as you can see on the chart, it was some declining trend line in progress. For example, the first one was in progress at the end of 2009 till 2013. And the upside breakout of this declining trend line trigger a very bullish movement on the Japanese yen. This is the first important thing, that the trend now is on the upside on the Japanese yen. On a more short-term view now, as you can see, it was another declining trend line in progress during 2014, and the Japanese yen broke above this declining trend line. So it is another bullish element for the next coming days and weeks on the Japanese yen. And also, as you can see, the blue moving averages, the 50-period moving averages, provide a support level on the Japanese yen. So as long as the Japanese yen remains above the 50-period moving averages, we are still bullish on the Japanese yen. And our stop loss is set at 150. 150 is on a horizontal level, a support level on the Japanese yen. So as long as the Japanese yen remains above this level, we are bullish. And the first target to the upside is set at 110.50, and the second one 115 on the Japanese yen. Only the downside breakout of 150 will invalidate our bullish scenario on the Japanese yen. And in this case, we could see a consolidation toward 94 at first target to the downside. But the main idea is to try to enter long position on the Japanese yen, because the trend now is strongly bullish, and we have seen few weeks ago a bullish signal on the Japanese yen. That's it for this presentation. If you have some question, feel free to ask me some question on the chat box. I'm here to try to provide you some answer. So I'm waiting for some question. So actually there is no more question regarding this webinar, so I was very glad to provide this webinar. The main idea is for the next coming weeks to try to enter long position on the Japanese yen, and to try to enter long position on the Canadian dollar, to try to enter short position on the euro dollar. This is the main view, and we remain bullish on the Australian dollar. So I was very glad to provide you this webinar today, and I hope to provide you another one very soon. Thank you very much. Have a nice day.